Okay, if you look at a gold chart going back to when they made it legal again in 1975, we've had that was a peak in gold. It had gone from $35 to 200 before it was legalized. Then it legalized at 200. It dropped in 1976 to just above 100, 50% drop. Between that mid 1976 and 1980, it went up eightfold. Take that bare low price and multiply it times eight. It went up to $850. Okay, and then it leveled off for decades and made a low in 2001, 2002 around 260, and went from 260 to 1920 by 2011. So 10-year bull market, different age, but also an eightfold move. Okay. Then you go to the recent low, the bear low in 2015, 1050. Well, let's say we're going to just match what the other two bull markets did. Eightfold means 8,000 plus gold.
Michael Oliver explains that after gold became legal in 1975, its price first dropped from about $200 to near $100, but then rose roughly 8 times to reach around $850 by 1980. A similar pattern happened between 2001 and 2011, when gold increased about 8 times from $260 to $1,920. Based on these past cycles, he suggests that if the same pattern repeats, gold could reach around $8,000 to $9,000, not as an exact prediction, but as a comparison to previous bull markets. He also says that silver stayed capped near $50 for nearly 50 years, but this has recently changed. Since 2024, silver has broken out strongly, moving from about $56 to above $70, showing it may start outperforming gold. He emphasizes that war is not a major driver of gold and silver prices. Instead, their movements are mainly based on market trends and technical factors. The sharp drop in late January was the main correction, and the decline during war news was just part of that same move. Overall, he believes the market tested its lows and then bounced back strongly, which is a bullish sign. Before getting started, make sure to subscribe and enable notifications so you don't miss any updates. If you find the content helpful, hit the like button and feel free to share your thoughts in the comments.
Just to equal the dimensions of the last one. In fact, what we find interesting, and we've been saying that for a year or so, that's not a target, by the way. That's just saying, hey, just to match the prior two, do it again. JP Morgan came out with a number like above 1900 as a fundamental target. That was interesting. Above 9,000. So even above the 8,000 level. So, but silver during all that time, 50 years, was capped at 50, 50, 50. Yet gold would blast out the highs. Silver would go up with gold, but it wouldn't get past the 50 level. Well, that changed. And we anticipated that it would. 2024, we said silver at $26, primary buy. And then in June 25, silver pushing toward 35, we said accelerations to begin. And our last buy signal, and it will be our last primary, was November last year when silver was 56. Because at that point, silver broke out versus gold on a relative performance basis, a technical basis, saying, hey, I'm going to beat you. I've been lagging you. I'm going to beat you now. And since then, well, you can see what silver's done. It was $56 in November. And yeah, right now it was 73 on Thursday, yesterday, in a pullback. But as far as the war news, again, that occurred in early March, and silver was above 90 then. But the real collapse in silver came one day at the very end of January, where you dropped down into the 60s by the first trading day of February. So in a day and a half drop, you had the full drop. The only thing silver's done since then was after rallying back up to 90 plus early this month. Then the war hit, you're right. It sold off instead of going up like people think it should, which it doesn't. They don't follow war. War is not a fundamental for gold and silver. And it came down and nipped out 2 weeks ago. We took out the February low, which is for silver like 66 something. We get down to 61.20 and immediately rocketed back up into this mid 70s. Like, ho, 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 fooled you. Okay. take it out to February low. Gold did the same thing. Got down to February low was $4,223, I think. We went down and swept that, got to 4,100. And 2 hours later, we'd rallied hundreds of dollars after taking out that low. And gold's now, we've hit 48,000 last week, 4,800, excuse me, last week. And I think we settled about 47, something like that. Anyway, but war is not an issue. And most of the damage, the war sell-off was merely within the context of the already drop that had occurred in late January, if you get my point.
Michael Oliver says silver demand is very strong due to solar panels, especially from China. Rising oil prices don't hurt gold and silver. In many cases, they rise together, even during recessions. He explains that in a recession, central banks print money, and that money often flows into gold and silver instead of stocks. He also believes the current stock market is a bubble caused by years of cheap money, and this supports higher prices for precious metals.
Well, it's going to take a lot to cut the demand side because the solar demand for silver is extraordinary. And, China produces most of the solar cells and photovoltaic cells that go in the solar panels, like 80, 90% of global production of that. And it's in great demand, particularly as oil goes up. And by the way, oil going up does not hurt the monetary metals. There have been plenty of times when oil has exploded and monetary metals have exploded during the recession as well. Okay, late 70s. Okay, people say, well, if you have higher oil prices, that is going to cause a recession. Therefore, that'll cause gold and silver to go down. No, the central banks go ape when you enter a recession. And the money never flows to where they want it to go, which is the stock market bubble that is already breaking, and therefore the bad data points that they're trying to save us from. The money flows elsewhere, and it's almost always gold and silver. Used to be T-bonds, too. Not anymore. So you're left with one alternative right now. So that's, as far as the global issue of oil prices, oil is still cheap at 100 plus. Look at its old highs, go back, 2008, 2022, and so forth, 150, 140, 130, that kind of thing. So gold at 110 is just sort of getting up to the old nominal price highs. Remember the degradation of the money unit. If you degrade the money unit by 80% a decade in terms of increasing its quantity over time, then the price is something that decades ago, if you factored in the monetary degradation, should be quite a bit higher just to reflect the decay and piece of paper you're using to measure it by. Gold does that, and oil has done that. Silver is now finally doing that. But no, I don't think oil is going to cause a recession. We think there's a recession or worse coming anyway, and we think that's been built into the factors. And it's a stock market bubble that we're sitting on and looking at. And if you want to know why we have a stock market bubble, look at an M2 chart and then look at a Fed funds rate chart. Going back 3/4 of a century, you can get one on the Fed site of St. Louis, get an M2 chart and a Fed funds rate chart. And even with the rate rises that we've seen since 2009, where 10 of those years was zero rates, and then they had some rises up to like 5%, okay? Even that level is dirt cheap, historically speaking, if you go back and look at 75 years of Fed funds. So the Fed has kept money cheap and almost free for 16 years or so. And therefore, it's a drug-induced bull market, because you've got massive liquidity flows, cheap money, and people make investment decisions based on that factor, which is falsely fed to them by the central bank. In other words, if you had a free market pricing of money, I doubt it would be free.
Michael Oliver says the stock market is currently in a bubble, and when it crashes, central banks will panic and print more money. This is why gold is strong, not because of war. He explains that silver mining stocks are still undervalued but have started outperforming gold miners and even metals themselves. He believes silver and silver miners will continue to rise faster than gold. He also adds that oil's rise was expected due to it being underpriced, not because of war, and overall commodities are entering a strong upward phase.
Anyway, so you built into the stock market bubble, and we are exemplary leader of that right now. The U.S. is. Europe to some extent. Japan is also a bubble. When that bubble breaks, that's when you're going to get all the dark data points again. And you know what the central bank will do at that point, what they're already doing. They're going to panic and they're going to print more in various ways. And gold knows this. So that's what's going on, in other words. That's not the war.
What are your thoughts on the gold and silver miners here? They still feel very undervalued compared to the metals themselves, particularly silver miners. If we look at the SIL and the SILJ ETF year to date, they're barely outperforming the metal, basically just keeping pace with the silver price itself.
We run spreads on that, meaning we measure the miners versus gold, silver miners versus the gold miners. And the silver miners have actually technically broken out. They broke out a half dozen months ago relative to the gold miners on a spread basis. In other words, if you take the price of SIL and divide it into GDX, express the answer as a percent, and plot that month to month. There was a breakout 6 months ago or so, before this year started. And sure enough, the SIL has surged more than the gold miners, GDX. It's gone up more year to date, even with the recent drop. We put a simple graph chart out in the weekend report and showed that year to date performance of silver, gold, GDX, and SIL, and the S&P. And everybody thinks, well, we're following the S&P. Well, the S&P is down 6-7% on the year as of March's close, and silver's up almost 7. Gold's up a bit more than 7. GDX is up a bit more than gold, and SIL is up more than all the three prior ones, silver, gold, and gold miners. Net year to date, December close to March 31st close, which most people can't believe, but it is. And yes, technically we do prefer, in my own personal portfolio, I'm doing this, the silver side of the equation, either silver and or its miners. And I'm pretty heavily into the miners themselves with a focus on silver miners. Relative to gold miners. I think they will outpace, just like I think silver is going to outpace gold going forward. Yeah, it's game on for energy, but that didn't begin with the war. It began with our work said, and we announced this ahead of time. We said, if you close January out above a certain price level, which we did, our price level was 63.01. You needed to close a month above that. You did in January. February is a good month. And then March, the event happened and you exploded. The reason for the breakout in oil, we argued, if you wanted a fundamental reason, was simply underpricing. You look at its price, it was in the 50s and 60s. Go back historically, and that's dirt cheap, okay? At that, already, the Bloomberg Commodity Index, a broad metric, by the way, which oil does swing with, okay? Not month to month necessarily, but in general, the broad swings up and down. It's in sync with the broad commodity complex. Bloomberg broke out in October by our metrics at a price of $106.50, getting above that on a monthly close.
Michael Oliver says oil and commodities were already rising before the war, so the war is not the main reason. He believes oil is still cheap and likely to rise over the long term. He explains that smart investors are moving money out of overvalued stock markets into safer assets like gold and miners, and this trend may accelerate. He also says high oil prices won't crash the economy. The real problem is years of money printing and artificially cheap money.
It's since traded over 140. But much of that rally since October occurred before the war happened. Most of that advance, it wasn't the war that took you up that much. You were already gone, I think, to 130 before the war even unleashed. So you can't say, well, the Bloomberg went up because oil went up and because of the war. No. It was already headed up. In fact, many subcomponents of the Bloomberg, non-oil, were already quite strong. Base metals, grains, you name it, they're crossing levels that we determined as positive. So that's what I think is going on with oil. And we had a major momentum breakout signal as of January. And it's of long-term nature, meaning that signal is highly likely to render upside for several years. And I'm not going to I don't have a target, except to say that when you plot oil, a spread chart versus the S&P, it's like free. If you see the chart, it's like off the page cheap. You plot it versus gold, off the page cheap. Plot it versus Bloomberg. It's in the middle of its multi-decade range. It's not high. So oil is cheap by its own metrics. its own price history, and it's cheap measured to other assets. And the real issue for asset pricing, I think, is ultimately the money flows created by the central bank. And the public does not always put them only in the stock market. Because when the stock market gets overdone, smart money starts to get suspicious. They perceive more risk, less gain. They start to move their money. And I think you've seen that already in the gold miners over the last year or so. They've gone vertical compared to the stock market. Somebody's moved money. Now wait till the public gets the same mindset. Whoa. And that's what I think you'll see. And I think we'll see that this summer. I think we'll see a lot of acceleration where people will look at the price charts and say, golly, that's unheard of. Anyway, but oil is merely part of that package. Commodity assets. Yeah, oil price. We did a study, for example, there's a myth out there that, well, oil prices, of course, that's a key factor for miners, okay? Energy, okay? That's their key negative. And so oil prices going up, well, that means, their costs go up, cost of production. But if you do it as a percent of the price of gold, for example, and go back when oil was 2008, it was $150 or so, and then the other peak in 2022, and you go back and measure what was the price of oil as a percent of the price of gold. In other words, gold going up helps the miners, oil going up hurts them because production costs. But what percent is that production cost increase compared to the price of the metal they're getting out of the ground? It's gone from like 6% of the price of gold to 2%. And so even at the current price levels, oil is dirt cheap compared to where it was to gold, going back a decade or 2 decades. So it's not the same negative. Nominal prices don't mean too much when the money is decaying that rapidly. And especially when you start to break the stock market, and that creates additional money flows into something that's doing better, monetary metals. And the central bank therefore creates more credit, more liquidity flows to try to save those assets they want to artificially support, stock market, debt markets. But it doesn't go there because investors don't put the money where the Fed hopes they will put it. Instead, they put it into safe places. Used to be T-bonds and gold. Now it's pretty much left with gold and related. So that's what's really going on. And no, I don't regard oil as a threat to the economy. The threat to the economy is what's already occurred over the last 16 years or so. The monetary degradation and the investment distortions that it has created that were false.
Michael Oliver explains that gold, silver, and commodities are in a long-term uptrend driven by strong demand, money printing, and historical patterns, not war. He believes stock markets are in a bubble, and when it breaks, money will shift into safer assets like gold, silver, and especially silver miners, which may outperform. He also says oil and commodities were already rising and are still undervalued, while the real economic risk comes from years of cheap money and monetary imbalance. Question for viewers: do you think gold and silver will outperform the stock market in the coming years? Let me know your opinion in the comments. If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. Thank you.